Hello, welcome to Nucleus Investment Insights podcast. Each week we explore the themes and trends shaping stock markets, currencies, commodities, global investments, giving you the insights you need to stay ahead. My name is Damien Klassen, Chief Investment Officer at Nucleus Wealth. I'll be hosting and sharing my insights and findings throughout the show. Don't forget to like and subscribe if you find our insights useful and you want more of them on your feed. Quick reminder as well, everything you hear today is general advice. None of it is personal advice. If you are looking for personal advice, then you can follow the show notes. With no further ado, let's jump in and talk about housing. So for regular sort of listeners and readers, you'll know that I've got a model that I look at it, which sort of tries to assess housing with the lens of affordability. And so, and I guess the sort of genesis of this is, how do you actually put how do you put a price on housing and an evaluation on housing in terms of, when should you be buying and when should you be selling, and how does it sit in terms of versus stock market investments and all that type of stuff. And so the real thing I wanted to come back to was that when you look at it with that lens, there's housing's a little bit unique in terms of there's two parts. There's the investment metrics you can get on it, which is sort of you basically your yields and your growth and things like that. And they become sort of, or they've certainly for ages sort of been very disassociated from what's going on in the housing market. And why is that? Well, it's because housing is not just an investment asset, it's also an asset where people want to live in it. And so the idea is that, what we wanted to do is sort of have a look and say, well, how far can things push in terms of these, and what are the constraints around buying a house that should put a limit on prices? And there's a couple of things that go into that. One is the idea of wages. You've got to be able to afford to pay for a house, and it's the ongoing cost that really matters. And then secondly is rents, in terms of, a purchase of a house is effectively you're substituting a mortgage for rents. And so when, for example, if we're going to use the Sydney market, when rents are half the price of a mortgage, then there's downward pressure. And when it becomes cheaper when the cost of rent is roughly the same as a mortgage, that seems to be a bit of a base within those markets. And so trying to look at it through that type of lens. So with what I'll start with, though, is sort of I'll take a bit of a step back, because I want to really talk about some of the overall trends within these, because when you look at it with that lens, there's really a couple of things that matter. Interest rates. We're talking about what are wages doing, what are rents doing, and then within that there's an inflation that sort of fits over the top of both rents and interest rates as well. That's sort of a bit self-limiting in terms of that. And then once we go through those, I also want to look at these calculators, a calculator we've got online that you can jump in and have a play with yourself, and just see what levers pull and what it does to various investments. So I might start with this idea of what even is an interest rate, and I guess it sounds pretty simple. Like the interest rate, there's the standard variable rate. The RBA sets this interest rate, and there's there's fixed and there's variable rates and everything like that, and how does that actually affect the housing market? And I guess the way I'm looking at this in terms of the housing market is there's two effects. One is people already have a mortgage. There's a bunch of people who already have a mortgage out there. They're paying whatever they're paying. Some of them fixed, some of them are variable, some of them have discounts, some of them don't have discounts, whatever it is. And the RBA puts interest rates up and down, and that affects the entire economy. So that will affect that. But it doesn't really affect the housing market in the sense that the number of people who are sitting looking at their mortgage and going, actually, I just can't afford this, I've just got to sell the house, is a relatively small subset. And that tends to be people as well who are, there's a sales part of that, but it tends to be more about people will hold on to things as long as they can before they sort of give up on that. So it's more about the new people coming into the market. So I guess what I'm trying to look at is a lens of saying, okay, we have this housing market. Are people actually looking at it and saying, I'm renting at the moment, it's going to be cheaper for me to get out, or I can either afford, or it's going to be cheaper, or it's going to be more stable, or whatever the reason is, in order to be able to get into the housing market. And so for those people, what really matters is that current interest rates and where that sits. And so what I've used for this, and I've got this chart showing up sort of 3 different lines upon this. One of them is the 3-year fixed rate. The other one is the discounted variable, and then this blue line is sort of like a bit of a mixture of the two, in terms of saying, well, if people turn up to get a mortgage, let's say we're picking this time in 2020 and 2022, where you can get your standard variable rate is going to be much higher, but you can lock in this 3-year rate at a low level. What's going to, how do people treat that? So the choice of you turning up and you're like, well, I'll just take the lowest of whichever I can get, the 3-year or the standard variable rate, whichever one is the lowest, that's the one I'll invest. And that's the assumption we've sort of gone with in terms of this, in terms of new investors coming into the market. So that's one part. The next real sort of macro change we've seen, let me talk then about interest rates. And so now this question, we've seen interest rates starting to tick up now. That obviously is a negative for affordability. But the question is, are we into this new regime where interest rates are now heading up, and they're going to, we're going to be raising up by 1%, or is this just a head fake, and interest rates are going to be going back down again soon? And so that's sort of one of the key, or that is one of the major effects that goes into it. The other one is this idea of rental income. And I've got this chart up just showing Australian advertised rents. And you can see that it's just, the slope of the line has changed significantly since COVID. And the question is, are we in this new normal where rents are just going to start rocketing forever? We're going to see we're on this new 45-degree line, and this is it. We're just going to keep pouring more people in, and we're going to have record low after record low in terms of vacancy rates, and so rental growth is just this new. We're in a new paradigm, or is this a unique period in time, and we're going to go back to more what we saw, for most of that 2020s, where rental growth was actually pretty low. And basically either in line with inflation or lower than inflation. So that's your rental boom side. The next side, so again, I will sort of try and answer some of these questions as we go along in terms of what my thoughts are. But I guess these are the big ones anyone looking to invest in housing should be thinking about. The next one then is we're talking about is saying the real wages. And this is one area in Australia in particular, despite the RBA sort of talking about wage growth being, one of the reasons for raising rates is things to do with wage growth. Australian real wages are back at sort of levels from 15 years ago. So and you can see I've got a chart just up showing that the fall in Australian real wages and how even if you take the RBA's projections, they really aren't looking for much in the way of wage growth. So that's sort of that's a limiting factor as well in terms of how we're looking at these prices of houses. If you look then again at where that's been going recently, we've got this. The ABS has this wage price index that they use, and we've sort of got there's a Commonwealth Bank runs this wage insights thing as well, and so you can see that they're pretty well tracked to each other, but it's certainly coming down over that time frame, and that's sort of tracking the fall in inflation. So a lot of that really has been inflation that's been driving that wage growth. There really hasn't been much in the way of real wage growth. And we actually had a real wage decline over a big part of that period. If you take out the government, it looks even worse. So I've just got this chart up showing that the private sector wages are well below what we've seen in terms of public sector. So public sector's sort of been ticking along at sort of 4% growth, whereas private sector is closer to 3%. And then if you so it's sort of this idea that government is well, in this case, government's helping to prop up wages, but I guess the real economy is looking worse than what you might think if you just take them both together. The other one is this idea of what they're calling market and administered inflation. So the idea is if you look at things like utilities, property rates, childcare, health, things that are where the costs are largely driven from the government, we're seeing significant price increases within that sector. Whereas if you look at more market goods and services, there's just not much inflation there at all. And so it's this idea that, is the government making things worse in terms of the inflation side? And if that's the case, how long can that go on for? And our market forces going to bring that inflation back down again. Again, I'll run through this in a bit more detail, but I just want to sort of talk through these headline issues before I start jumping into these. And then finally, I just sort of wanted to talk, this, if you look at the prices you can get, if you look at the CPI, so the inflation rate, which is the black line on this chart, and then the firm's reported output prices. And you can see there's this real disconnect between those at the moment, where output prices have been falling quite significantly, but we're seeing that those measures of inflation are still high. And that's that whole part about saying, well, if it's mainly governments and health and education that's doing this, then you can see why there's that disconnect, is that we don't have inflation throughout most of the economy, but in this small administered part of the economy, it's not particularly small, you do have significant inflation throughout that. Okay, so that's the background behind the measures. Then I want to I'm going to use an example of the Sydney housing market, just to give you a framework for how I'm looking at this and just seeing what's happening within that market. And then we're actually going to jump into the calculator and have a look at what it means when you change some of these assumptions. So Sydney houses, I've got these three measures. These are our affordability measures. And the idea is that, first of all, it's mortgage payments versus the median wage. Now, there is some element, you probably see some element of upward bias towards this. So we're going from 1980 up to, so the last sort of 46 years of data. So the number of workers per household has increased over that time frame, and so arguably, I guess there's greater female involvement in the workforce. Having said that, the most of that increase was early in the piece. There hasn't been anywhere near as much change in that over the last sort of decade or so. But the idea is that there's a certain stage where if you're sitting at the moment where it's basically you're the 93% of the median wage needs to be assigned just to make the median a mortgage payment on the median house as a starting point. So this is where if you go into a house, you're going to get 80% as a mortgage and 20% as a payment. How much are you having to put away? And you're basically saying, well, you got to put all of one median wage. So you need two workers, probably. One of them's devoting their entire salary to paying down the house, and keeping in mind that this is pre-tax as well. So it's probably more like you're taking the entirety of one person's salary and a big chunk of the other person's salary in order to pay them the mortgage. And so that's sort of sitting at basically the 96th percentile. It's right up there. So, and it's getting slightly worse at the moment. But, if you came back to a more normal level, you'd probably be maybe not half, but close to half those levels. So that if we're at 93%, your more normal level sort of back around, 60% over this time frame. Then you go, so that's one part. Then this idea of the mortgage payment to rent. And so that again is at sort of 93rd percentile. So it's very expensive. The only time it's been more expensive is the last, couple of years. So it's basically about double. So within Sydney, if you want to buy a house, you basically got to pay in mortgage about double what the cost to rent an equivalent house within that. So that's at at its peaks, the Sydney housing market does seem to be is way higher than most other markets, but it does seem as if, when the rental cost is below 100%, so basically, if it's cheaper to get a mortgage than it is to rent, then that's really your upward bias. But realistically, for the Sydney housing market, somewhere between 140 and 170 sort of seems to be the range that it's traded at for the last couple of decades. And so we're certainly a lot higher than that at the moment. But again, there's this question: is it a new paradigm or not? The last measure of that, the property price to median wage, that one I'm probably less. I've got it there for interest as opposed to because I think it's a major factor in this, and part of the reason for that is that this is really about getting into the housing market, and as you can see from that line, it just goes up and up and up and up. The question is, where does it stop? And it's pretty hard to. I think that one's much harder to say where does that stop, because that's about how do I just get into the market. Once you're in the market, okay, now the top two are the most important. It's you got to be able to maintain those mortgage payments over time. And so whether it's the bank of mum and dad, or it's savings, or it's whatever it is that's got you there, I do think that one's less. It's less of a limit on terms of where house prices can go. Okay, so that's our background for it. There's some affordability measures. Sorry, no, that's our affordability measures. We do have some investment measures, but as I said, I feel like the investment measures, while they're sort of important in a way for houses, I think over time they've sort of shown to be, well, it's pretty hard to tell. So say if we're looking at gross yields, you used to be able to get sort of 8 to 10%, and now it's 3%. How low can it go? And it's sort of, the question is hard to tell. If we do a sort of a more complicated one where we try and make an estimate of the net yield that you can get on houses, and then subtract that from the mortgage rate, it looks all right on that basis. It's about half where it's been in the past. Sorry, it's about the 50th percentile, not far away from the 50th percentile. So, but it's on that basis, you're basically saying, well, you're only losing 3% per annum on that. So which this is a permanently negative investment measure. Is not really the type of thing you're looking for. So it's basically saying, you're happy to take a loss on the carry costs. I'm happy to lose 3 or 4% every year with a view that house prices will go up by that. We'll go up by a certain amount, and I've got leverage in the game, and we're going to talk about that whole leverage situation in a minute as well. Okay, so that's our background to these. And what I might do, we'll go to a quick message, a sales message, and then I want to come back and then talk through this calculator and how we can sort of see what happens when we start playing with some of these numbers.
We'll be back with the investment insights very shortly. Nucleus Wealth is an active and passive investment manager. If you like what you're hearing and want some help with your investing, we can do it for you via our active portfolios. Our tactical and core portfolios use the insights shared in this podcast to construct and manage your investment. We blend tactical portfolios to offer our combinations of international shares, Australian shares, government bonds, and cash. We vary the asset allocation with the goal of protecting your capital in times of market uncertainty. We also have active international and Australian share portfolios. These are chosen using our quality and value investment philosophy. You can find out more at nucleuswealth.com. Now back to the show.
Right, so we've got this calculator. You can get this from the Nucleus Wealth website under the calculators and property. So I'm just going to look at. I want to run through this and show you how to sort of pull the levers and see what the differences are when you're sort of using this model. So the idea is, I'm going to start through. Let's start looking, say, at a house. Just given that's what we've been talking about, but there is sort of a unit one as well. So we'll choose and say we're going to look at a house. We'll look at Sydney. Let's call it 1.5 million. You can play with those costs, and let's say you're putting down 200,000 as a deposit. And then what's your rent going to be? So it'll automatically, when you go through and choose those, it'll automatically set it to what the median rent is within that market. But you can then go in and change that and say, okay, well, if this is talking about $880, I want to make it $1,000, or whatever it is. You can play with those numbers. But let's just stick with the median rents at the moment. So we're talking about the median rental return you can get on these ones. Okay, so that's our sort of setting. Then we get in and have a look at the economic outlook. Now I'm just going to choose moderate growth at the moment because I want to. We're actually going to play around with these assumptions and have a look at what we're expecting. So that's that one. Then we're going to just jump through to the next. Now this question is, how do we want to forecast the returns from property? And I think I'm going to focus on these first two because I think they're the ones we really want to look at. And so we're either going to do it as a mortgage cost to rent or a mortgage cost to wages. And so let's say I said, look, I want to use the mortgage cost to rent as to start with. And I think this is going to go back to its 10-year average. So we've got those lines on the chart. You can see those lines here. This is where it's traveled. We spoke about how it's at 190 something percent at the moment. And, if we're saying it's going to go back to about 170% or something like that, we can play around with those figures. So let's just say it goes back to about over the next couple of years, it sort of gradually drifts down and get back to about 170% of the the cost of a mortgage is 70% more than the cost of renting within the Sydney market. Okay, so that's where we've got to from there. That'll then spit out and give us some answers. So, but let's not talk. Well, actually, I'll run through quickly what this is telling us at the moment, and then we're going to go through and play with the assumptions behind this because I think that's the key part. Is it's really about coming back to those big ticket items I was talking about, that rental growth, the growth in wages, and what that's doing to interest rates. So at the moment, this is basically saying if we ran this over a 10-year period, so we buy in and then we sell out after 10 years. So if you held the property without any debt, you can see that's effect. That you start off down because you've got to pay your stamp duties and stuff like that. But over time, you end up in front on that whole deal. You make 50 grand out of it, out of that investment over that 10-year period. If you hold it with debt, though, this is where, because of these leverage issues, you actually end up losing sort of 300 or 400 grand on this. And this sort of breaks it down as to why. So you start off with your 200,000 because that's, the house is worth 1.5, but all you've put down is 200,000. You've paid sort of your entry costs of about 90 odd grand to get into that. And then you're looking at your rent over that 10-year period. You get sort of 500,000 in rent. You've got property costs that are coming off that. You've got the biggest one there, that interest cost, and then your change in property value, and so your property is going up in value, but because you've paid far more in interest than what you have got back in rent. Then you've got some exit costs, and finally you've sort of got this net return that you're getting out of the whole thing. So let's go and play with these assumptions though, and the big thing here is that idea that, look, if you're just investing in it, sure, you're making money. You're not going to lose money on the assumptions we put in. But if you're going in there with leverage, that's where you can lose some significant amounts. So I've got these assumptions. So you click on this one to get these, adjusting the assumptions. So the inflation rate, and so we can see the longer term inflation rate. So let's say we'll tick that up a little bit. That'll help you in terms of your mortgage, because what that does is over time, it means you're going to get back more in terms of rent. And we're talking about a ratio of mortgage payments to rent. So we've got a rent's increasing faster, which sort of helps pay it off earlier. Wage growth isn't going to make any difference to this one, but so let's leave that for the moment. And then we've got this idea of what is this rental growth of the property. And so if we think it's going to be, so the longer term rates on this have been zero, but as we spoke about, this has been rocketing at the moment for the last few years. So if you said, okay, actually, no, I think that rents are going to grow at far above what they have in the past. I think we're into this new paradigm. We're going to keep pouring people in. The building's not going to keep up, and rents are just going to keep skyrocketing every year. So keep in mind, this is real rental growth. So if we're talking about 2% real rental growth plus your 3% inflation gives you 5% nominal, which is, we haven't really seen rental growth that high, nominal rental growth that high over time, but let's say you had quite a positive view on that. Now you can see that this property is, you're underwater for a bit, but actually then you start taking off because that whole, if you can just keep racking up 5% real rental growth every year, that'll help solve that problem and your interest. You change in property value. You don't actually end up with that much more rent received, but your change in property value does sort of take off and give you that benefit and that leverage of those. So if you took quite a positive view on that, the lower you go, if you said, okay, actually no, maybe there's going to be a bit of catch up, or maybe we'll have like a pause in terms of the number of people that come through, and you'll have a few years of actually below. We've been above the averages for a while. We'll have some below average rental growth. Now you're talking about much bigger losses in terms of those, and you can sort of see where your property value your property value is still increasing. And I want to highlight this. This is talking about losing 500 grand on this over time. But where's that coming from? Well, 150 of that's coming from your entry and exit costs, and then your property value is going up, but you're sort of basically washing your face on those. It's really the fact that you're paying so much in interest over this time. So anyway, so that's that part of it. You've got the real rent growth, and then this real key part is this mortgage interest rate. Where is that headed? Because if that's sort of headed, if we're into this rate rise cycle now, and we're saying, so let me put back the rental growth to something, let's just say it's going to be more like its long-term average. So the question is, if we think we're going to sort of some mortgage rates that are going to be much higher than what they've been in the past, because we've now got government spending lots more money, we've got this endemic inflation, and we're just going to see money printing and sort of more, I guess, Trumpian economic policies, which is just let's just let these economies run hot. Then you're looking at mortgage interest rates, and you're looking at mortgage interest rates higher. That's where you actually see that some real massive, you're losing half your value on this, and it's all on the interest cost. You're just paying far more in interest, than you're now not getting any sort of change in property value, or very little change in property value, and you're just paying far more in interest. Whereas if you sort of had the view that, look, no, actually we're headed back to low interest rates, deflation, productivity gains, AI pushing prices down, job losses and from AI and these productivity gains, China pouring out cheap products to everyone, and going back to sort of interest rates of sort of 4% or something like that over the longer term. Now you're actually talking about that, property, giving you this net gain over the time frame, and so with it, even with these assumptions, sort of more conservative assumptions. So I think that the key for me is just sitting there, have a look at these and just pull the levers, because this is what, if you're going to invest, $1.5 million or $1 million in a property, from an investment perspective, which is different to a lifestyle perspective, but from an investment perspective, knowing what are the levers and what are the bets you're really taking. Okay, so that was our mortgage payment to rent ratio. The other one we could do, so we can just sort of jump back to that forecast method and say, well, what if instead of doing that, we're talking about mortgage cost to wages? And again, we're saying, okay, so historically it's been in Sydney, it's sort of been 50-60% for most of that period. We're at sort of 90% at the moment. Maybe that comes back. Maybe it doesn't go back to its 10-year average. So its 10-year average is about 70%. Maybe it doesn't go back to there. Maybe it goes back to 80% over time frame. And so you go, well, if that happens, what does it look like? And you go, let me just go make sure I've got all those assumptions. I might reset to a few of these. Average growth, wage growth, rental growth doesn't matter anymore. Let's put the mortgage rate back up to 5.5%, so we can sort of get our baseline. Is it, again, we're sort of back to those similar types of losses, that sort of $500,000 loss over that time frame. And again, most of it coming from the idea of that interest cost. And now you can play around with those and say, well, what do I genuinely think, is inflation going to be high? Because if inflation is going to be high and we've got some sort of average wage growth, then that will then help help the equation for you. So now that sort of, knocks off a bit. If it's 3.5% inflation, now we're reducing that back from $500,000 to a $250,000 loss. And if you start saying, well, at some point, we've sort of been through this negative side. Maybe sometime we'll get the other side of this. We'll get this wage growth will actually be higher than average. And you sort of go, well, maybe we're going to go through this, a bit of a boom in terms of wages and productivity gains from AI, and that's going to flow through to workers. I hope you're right, but if you had that view, you can sort of come back through and see, okay, what is that going to do? He's going, well, I'm still losing money on this whole thing. Really, under this scenario, if I'm going for pretty high inflation and pretty high wage growth, but you've got this mortgage payment to full-time wages sort of reverting back to its mean, what you really need is low interest rates. You're really taking a bet on interest rates going down. And so let me recalculate that. So, if we're going back to 4.5%, now we're starting to make money on this deal over that time frame. So that's the big picture. I've encouraged you to jump on, have a play around with it, look at the different assumptions, and I'm going to come back and talk about what that means from an investment perspective just after this quick message.
We'll be back again shortly. If you like what you're hearing but want a low-cost passive option, Nucleus Wealth is the first to offer passive direct indexing in Australia. The first generation of passive investing was index funds. The next gen was ETFs. Now direct indexing is here with significantly more customization and control. The benefit of direct indexing is you can add or subtract investment themes, and we have almost 100 different options to choose from. For example, you could buy an international share direct index portfolio that excludes fossil fuels and arms manufacturers and has a tilt towards cybersecurity and cloud computing. Alternatively, you could buy a portfolio with no screens and an extra exposure to nuclear power and defense contractors. You can find out more at nucleuswealth.com. Now back to the show.
Right. So what we've got within this is, back to that prior chart first. So these are the property valuation ratios across the different markets and houses versus units. So I spoke about Sydney basically being double. Melbourne's not far off. Brisbane's more like 50% higher. And Perth's about 20% higher in terms of mortgage payment to rents. That's sort of running down this left-hand side of it. And then you can see units are considerably cheaper than that. Then we look at sort of what the mortgage payment to full-time wages are across all those, and that's sort of comparing the wages in each economy to that. So you can see Perth again, 50% or 54% of the full-time wage, partly because wages are higher in WA, but also there's the lower prices as well as higher wages. And then, those other measures within that. So that's sort of, those are interesting in a way, but I think probably what you really want to see is where do those sit versus time, versus where they've been in history. Because that's the part where, and that's the next chart I've got up, which is showing as a percentile, where does it sit? So if you're at 100%, you're more expensive than it's ever been on that front. So let's say we're talking about mortgage payments to full-time wages. Well, Brisbane, Adelaide, Perth are all at the highest they've ever been on those fronts. Sydney's at 96th percentile, and Melbourne's, the cheap one in there at only the 92nd percentile for mortgage payment to full-time wage. And then you can see though that when you pull back those measures back into the units market, it does look, it's certainly not at the extremes anymore. So it's still expensive, particularly Brisbane, Adelaide look a bit expensive on these measures, but Sydney, Melbourne, Perth are sort of the 50th to 60th percentile. So sort of, above average, but not wildly above average. So certainly much more affordable on that front. So that's those ones. You'll be able to see, like, there was a report coming out tomorrow which will run through each of the different markets for each of these. So I'll just bring up, for example, the Sydney units market. You can see sort of that mortgage payment to median wage, where that goes over time. So it's at 45% at the moment, and that's sort of not that far off where it's been for most of the last 20 years. So you can see those ones. The other thing I've got on there as well is some of the economic stats, and these are the keys to it. So actually, let me just put that at full screen so you can see the whole thing. So there's four things that I think you really need to be focused on. This idea of wages. So are wages actually growing? So real wage growth. And I've changed this to go over 3 years just to sort of bring down the volatility a little bit in this. So real wage growth has been quite negative for some time now. It's running at about 0.5% per annum, on a 3-year average. And you can see even that those nominal wage growth, really only running at 3.6. It's just not that high relative to history. And I think what you'd want to see, if you're seeing inflation of 2.5% and real wage growth of 1%, that's a more healthy economy. Whereas I think what we're seeing at the moment is still quite weak wage growth on that front. So if that turns around, you can be more positive on houses. If that stays low, then it's just hard to see where we can get much in the way of house price growth, because you're just running up to that part about if people can't afford the mortgages, then it's just hard to get that growth. The other one is this rental growth. So the long-term average on this rental growth is pretty close to zero. We've been rocketing for the last little bit. So we've been running it at sort of 3% real growth, which is basically higher than it's been almost at any other time in history. We had a short period around 2010 and a short period back in the 80s where it sort of was up at these levels. But realistically, real rental growth is usually considerably lower. And we went through a whole decade from 2010 to 2020 where it's significantly negative for most of that time period as a real rental growth. So I think there's that's this real key assumption that you're making in terms of that. Are we in a new paradigm where rents are just going to keep rocketing up, or is gravity or going to eventually take hold of this one and see that if you're not getting the wage growth, it's hard to get the rental growth. Okay, so that's one part. The other thing, just a quick aside on this is it is worth thinking about as well, is these numbers may not always be as connected as, if you're buying an existing house, there's a negative connotation to some of these. So if you're getting rental growth, say, if we're getting real rental growth of pretty close to zero across all houses, that probably means that if you've bought something, your real rental growth is actually going to be slightly negative. And why am I saying that? Well, because there's people out there spending lots of money on houses where they're building new ones, they're upgrading, they're spending all this money, all this capital on it, and then getting higher rents within that. So basically, if you're averaging zero, and within that average, you've got people building new houses that are probably better and charging higher rents, and you've got people doing big renovations and then charging higher rents, then the house that's just sitting there not doing the renovations has probably got negative real rental growth. So yeah, sort of keep that in mind as well in terms of the actual investments you're making. I think there's these potentially even overstate, I think, the returns you might be getting on some of these. So that's your two big ones. And then your second ones really is coming back to these more economic ones, is this idea of, well, what's inflation doing and what are mortgage rates doing? And so if we're looking at, and that mortgage rate within any of those affordability is that real key to it. If you're of the view that we're in Australia's got a structural issue, and that inflation is certainly higher here than what we're seeing elsewhere, we're one of the few countries raising rates. If that's endemic in the Australian economy and it's going to continue for some time, then those high mortgage rates, really going to cap any housing price movements. If, on the other hand, you're like, no, it's all a head fake. There's all these other factors that are actually going to drive interest rates down and down considerably over time, then that changes the equations more than anything I've spoken about. So really, a bit of rental growth, bit of extra rental growth, higher or lower or whatever it is, it's great around the edges. It's this long-term factor you need to get. But in the short term, the mortgage rate is, and especially if you jump on and play with that calculator, the mortgage rate is the thing that really does affect whether this is going to be beneficial to you or not beneficial in terms of the overall your overall profitability on making an investment in terms of the housing market. And then last of all, that inflation. And so we have spoken about that. They're inextricably linked, those two. I think that your expectations on inflation should be matching your expectations on mortgages. So when you go back to that calculator and you are playing around with it, you can get some great results if you think there's going to be 5% inflation, but mortgage rates are going to 2%. That's going to give you the best profits ever in terms of the housing market. But realistically, is that going to happen? So I do think there's, as you're making your assumptions within that, you do need to take try and link those two together with that. Anyway, that was all I had. There hasn't been a lot of questions, so hopefully that's because everything's sort of been covered off and is all explainable. So thank you very much for tuning in to Nucleus Investment Insights. If you found today's insights helpful, give us a like and subscribe so you don't miss future episodes. If you've got any questions, leave them in the comments. We'll answer them in our socials. Don't forget to catch us live for the next episode, Thursday, 12:30 Australian time. For more insights, visit our website or sign up to our weekly email to get updates straight to your inbox. And particularly if you are interested in getting more data behind this, jump onto that site and you can get that weekly email. You will get the all the updates for all the different markets. And if you'd like to build a personalized investment portfolio, head over to our website to start your risk-free account, send us an email or book a free consultation with our team. Thanks everyone, and we will see everyone next week.